In a world that moves at lightning speed, staying truly informed, especially when it comes to something as intricate as India's financial landscape, well, it can feel like a full-time job. How do you cut through the noise and grasp the critical details that genuinely matter without getting lost in the weeds?
That's precisely why we're here. Welcome to the Deep Dive, where we take a stack of information, your articles, your research, our own notes, and basically extract the most important nuggets of knowledge and insight. We want to offer you a shortcut to being truly well-informed.
Okay, so today we're doing a custom deep dive into a really crucial document, the Reserve Bank of India, or RBI, news for July 2025. And this isn't just a list of updates. It's more like a window into the core of India's financial regulations, its economic pulse, and, well, its future direction.
Exactly. We're going to unpack every significant detail, fact, figure, term, and rule mentioned in this document. We want to make sure you get the full context, without feeling overwhelmed by all the jargon.
Right. Our mission today is to equip you with a comprehensive understanding of the RBI's latest moves. We're talking everything from new appointments to significant policy changes affecting, well, everything from your bank account right through to the housing market.
And we'll explain all the technical terms in clear, simple language as they come up. We want you to grasp not just the what, but the why and the so what. Think of this as your essential guide for understanding the granular details of financial regulations. It's perfect for anyone looking to be truly in the know, or maybe preparing for examinations like RBI Grade B.
Okay, let's unpack this wealth of information and see what the RBI has been up to.
Let's dive in.
So we're kicking things off with a look at some of the personnel and institutional updates from the RBI. It's always interesting to see who's stepping into key roles, isn't it?
Indeed, these initial announcements often set the stage. They reflect the ongoing evolution and governance within the central bank and, the broader financial ecosystem. They can signal a continuation of policy or maybe even a fresh perspective.
First up, a new executive director. The RBI has appointed Kesavan Ramachandran as its new executive director, or EB. That's a significant leadership role within the bank, right? Overseeing critical departments.
Absolutely, a very key position. And speaking of significant appointments, the central government has also nominated Anuradha Thakur. She's the secretary in the Department of Economic Affairs, Ministry of Finance, Government of India.
Okay.
And she's nominated as the director on the Central Board of the Reserve Bank of India. She'll be replacing Ajay Seth.
Ah, right.
This kind of nomination, it brings a direct link from government policy right to the RBI's highest decision-making body. It ensures coordination, at the highest levels, and a clear line of communication between fiscal and monetary authorities.
Okay, moving from personnel to institutional recognition. The RBI has also included 3 entities in the second schedule of the RBI Act, 1934. Now, for our listeners, can you quickly explain what it means to be a scheduled bank and why this inclusion truly matters for these institutions?
Certainly. The second schedule of the Reserve Bank of India Act, 1934, it's essentially a definitive list. It lists all banks recognized as scheduled banks by the RBI.
Okay.
Now, this recognition, it confers certain significant privileges and equally important obligations. For a bank, it's a strong mark of credibility, operational capacity within the banking system. It allows them to transact directly with the RBI, access its facilities like liquidity support through the repo window, and participate in interbank markets more broadly. That's vital for their day-to-day operations and growth. It also means they're subject to the full regulatory and supervisory framework of the RBI, ensuring their stability and adherence to financial standards.
Got it. So who are these newly included entities that have achieved this important status? Who's joining the list?
They are Ahmednagar Merchants Co-op Bank Ltd, Ahmednagar Deokari Nagari Sahakari Bank Ltd, Chhatrapati Sambhajinagar, and NSDL Payments Bank Limited.
Interesting. So we're seeing both traditional cooperative banks and a modern payments bank gaining this scheduled status. It really reflects the diverse growth in India's banking sector, doesn't it? And the RBI's recognition of different banking models.
Precisely. It shows the dynamic nature of India's financial landscape and, well, the RBI's willingness to integrate new players into the formal regulatory structure as they mature.
Okay, now let's dive into some substantial policy changes, starting with the Know Your Customer KYC directions. This is a big one. It truly impacts every single bank account holder, individuals, corporations, everyone.
This really is a crucial area. The RBI had earlier issued the foundational RBI Know Your Customer KYC Directions 2016. These were designed to comply with the provisions of the Prevention of Money Laundering PML Act 2002 and its associated rules.
Right.
The core purpose of those directions was to lay out the regulatory framework for how financial institutions identify and verify their customers, specifically to prevent the misuse of the financial system for illicit purposes, think money laundering or terrorism financing.
So the original purpose was definitely focused on preventing illicit financial activities. What's prompted the new amendments now? What's the broader aim behind them this time around?
That's a great question. Recognizing the ongoing need to further enhance consumer protection and service delivery, while, of course, maintaining vigilance against illicit activities, the RBI has now introduced amendments to that 2016 Master Direction.
Okay.
These new directions are formally called the Reserve Bank of India, Know Your Customer KYC Amendment Directions 2025, and a key point for everyone listening. These directions come into force with immediate effect. The focus seems to be on making the compliance process easier for legitimate customers, without compromising security.
One particular change that I think will resonate with many listeners is a new relaxation for low-risk individual customers. What exactly does this mean for them in practical terms? This sounds helpful.
It really does. For low-risk individual customers, regulated entities, REs, and let's clarify here, REs are basically the financial institutions under RBI's oversight, like banks, NBFCs, other financial intermediaries. Well, they shall continue to allow all transactions, even if their periodic KYC updation is due.
Oh, okay. That's quite a relief.
It is. However, there's a strict condition attached to this flexibility. The KYC must be updated within 1 year from the due date, or by June 30, 2026, whichever is later.
Right. Still a deadline.
Still a deadline, yes. And it's important to note, such accounts must still be subjected to regular monitoring. This applies even if KYC is already overdue. But yes, it offers substantial practical relief, particularly for those who might face challenges in ensuring timely updation. It prevents their accounts from being frozen just because of a KYC deadline.
That's a very practical change for customers. Definitely makes sense. How about making the updation process itself easier? I see business correspondents, BCs, are getting more involved, which is interesting. What's their role here? And maybe for those unfamiliar, who exactly are business correspondents?
Yes, this is a significant step towards improving accessibility, especially in remote areas. Business correspondents, BCs, well, they are agents contracted by banks to provide basic banking services, often in areas where physical bank branches are scarce or, non-existent.
Outreach agent.
Exactly. They can be NGOs, self-help groups, microfinance institutions, even local shop owners who've partnered with banks. Now, banks may obtain a self-declaration from customers through an authorized BC. This is especially useful if there's no change in KYC information, or maybe if the customer only has a simple address change. It makes it much more convenient than a trip to a distant branch.
So for these declarations, is digital the preferred method, or is physical submission still a solid option?
Digital is definitely preferred. ECs are primarily required to use electronic means to record and forward these declarations and any supporting documents to the bank system. And this is after successful biometric-based EKYC authentication.
Okay, EKYC.
All right. And EKYC authentication, that refers to the electronic Know Your Customer verification, often using Aadhaar biometrics or maybe a one-time password and OTP. Now, if the electronic mode isn't yet available, perhaps due to infrastructure limitations, physical submission is permitted.
Got it.
But the process for physical submission still requires biometric-based EKYC authentication, BC authentication of the documents, and crucially, an acknowledgement of receipt provided to the customer. However, and this is key, the final responsibility for KYC updation remains squarely with the bank. They must update the KYC in their system and inform the customer once it's all done.
What about reminders for customers? We all have busy lives, and sometimes these things can slip our minds. How is the RBI ensuring people don't miss these critical updates? Are there systems in place?
Yes, there are. REs must give customers at least 3 advance intimations before the KYC due date. At least one of these intimations has to be a physical letter, ensuring it reaches even those with limited digital access.
That's important.
Very. If KYC remains unupdated past the due date, then at least 3 reminders, including one by letter, must be sent. And these communications aren't just simple reminders. They must provide clear instructions on how to complete the KYC updation, outline an escalation mechanism for any issues, and clearly state the consequences of non-compliance. Importantly, REs must maintain an audit trail of all these communications, and this whole system for intimations and reminders, it needs to be fully implemented by January 1st, 2026.
And we also saw related amendments concerning inoperative accounts and unclaimed deposits. These seem aimed at easing processes, particularly for accounts receiving direct benefit transfers (DBT), electronic benefit transfers (EBT), scholarship accounts, and Pradhan Mantri's Yantan Yojana (PMJDY) accounts. This sounds like it directly impacts some of the most vulnerable sections of society.
Precisely. The RBI had observed a large backlog in the periodic updation of KYC records for these types of accounts. So, empowering BCs to facilitate KYC updation aims to clear these backlogs, especially in remote and underserved areas. It's a crucial step for easing access for customers who rely on these vital government schemes, ensuring their welfare payments aren't held up due to administrative hurdles.
This raises an important question. Beyond just allowing BCs, how are banks being encouraged to tackle this issue proactively? I mean, given the scale of India's population, it must be a huge task.
Absolutely. Banks have been specifically advised to organize dedicated KYC updation camps and also to launch intensive awareness campaigns, especially targeting rural and semi-urban branches and those branches known to have a high pendency in KYC records. These initiatives are designed to ensure greater outreach and convenience for customers, making the process as accessible as possible and, directly engaging with the communities they serve.
And an empathetic approach to account activation. That sounds very customer-centric and, frankly, necessary.
Yes. Banks are explicitly instructed to take an empathetic view while facilitating the activation of inoperative accounts. This acknowledges the real challenges many customers face, particularly those in remote areas or from vulnerable sections of society. It ensures they can access their funds without undue hardship or bureaucratic hurdles. It's really about putting the customer's needs first.
So what about simplified onboarding processes, both for face-to-face and non-face-to-face modes? How is the RBI streamlining this whole experience?
Okay, for the face-to-face mode, customers can be onboarded via Aadhaar biometric-based eKYC. A significant relaxation here is that if the current address differs from the one in the UIDAI database, that's the Unique Identification Authority of India, managing Aadhaar, a simple self-declaration from the customer regarding their current address, is sufficient.
Oh, that simplifies things.
It does. Digital KYC is also permitted for such onboarding, providing multiple convenient options.
And the non-face-to-face NFTF mode, that's become increasingly common, especially with digital-first banks and fintechs.
Right. For NFTF, customers can be onboarded using Aadhaar OTP-based eKYC. But this is subject to specific conditions. Such accounts require strict monitoring by the RE, and the full customer due diligence, CDD, that's the comprehensive process of verifying identity and assessing risk, must be completed within 1 year.
Okay, so there's a follow-up required.
Exactly. Other digital modes, like using a KYC identifier, equivalent e-documents, and DigiLocker are also allowed. For non-digital modes, copies of officially valid documents, or OVDs, certified by additional certifying authorities, the same ones allowed for NRIs and PIOs, are permitted.
And the gold standard for digital onboarding, the video-based customer identification process, VCIP, how is that being treated now?
VCIP is now treated as fully equivalent to face-to-face onboarding. It has to be conducted by an authorized official using a secure, live, consent-based audio-visual interaction to obtain all the identification information needed for CDD purposes. This really streamlines the digital onboarding experience significantly, reducing the need for physical presence while still maintaining regulatory robustness.
This sounds like a really comprehensive overhaul. It seems designed to make KYC both robust for fraud prevention and remarkably customer-friendly for ease of compliance. Balancing security with accessibility seems key here.
Absolutely. It's a very pragmatic approach to a critical regulatory function. It's adapting to the digital age while definitely reinforcing consumer trust.
Shifting our focus now to something that has significant implications for how credit flows to vital sectors of the economy. The RBI has revised the priority sector lending norms for small finance banks. Let's unpack this change. What's the background here?
Okay, this is a key change for small finance banks, or SFBs, and it reflects an evolution in how the RBI views their role and capabilities. Previously, an SFB was required to extend a pretty substantial 75% of its adjusted net bank credit, A and BC, to sectors eligible under priority sector lending, PSL norms.
75%, that's high.
It is. And just to clarify for our listeners, priority sector lending is a directive by the RBI for banks to lend a certain portion of their funds to specific sectors deemed important for the country's economic development, think agriculture, small businesses, education, housing. An adjusted net bank credit, ANBC, is a key metric representing a bank's total credit available for lending after certain adjustments. It provides the base for these calculations.
And how was that 75% broken down before this revision? Was it all mandated, or was there some flexibility?
Right. Out of that 75%, 40% of ANBC had to be allocated across specific subsectors as mandated by existing PSL prescriptions. These are sort of the non-negotiable core priority categories. The remaining 35%, however, could be directed by SFBs to any one or more PSL subsectors where the bank enjoyed a competitive advantage. So that provided some flexibility while still ensuring substantial credit to priority sectors.
So what's new now? What's the core effect of these revised norms for SFBs? When do they kick in?
Upon review, the RBI has revised these norms, and these changes take effect from financial year 2025-26. These revised instructions are issued under the authority vested in the RBI by Section 22(1) of the Banking Regulation Act, 1949, which gives the RBI broad powers to regulate banking, the core change, a notable reduction in their overall PSL obligation.
Okay, this next change sounds like it has significant implications for SFBs' balance sheets. The total PSL obligation for SFBs is actually being reduced.
It is. The total PSL obligation for SFBs is being reduced from 75% down to 60% of ANBC, or credit equivalent of off-balance sheet exposures, CEOB, whichever is higher. Now, CEOB, for our listeners, is a measure used to convert certain off-balance sheet items like guarantees or letters of credit into an equivalent on-balance sheet credit exposure for calculating things like capital adequacy or lending targets. So yes, this reduction from 75% to 60% is a big deal for SFBs.
And how is that new 60% now allocated within the SFB portfolio? How does it compare to the previous sublimits?
Okay, the new allocation structure looks like this. 40% of ANBC CEOB must still be allocated as per the existing PSL subsectoral prescriptions. So that part remains unchanged, highlighting the continued emphasis on these core priority areas.
Right, the core mandate is still there.
Exactly. However, the remaining portion, which was previously that flexible 35%, is now reduced to 20%. This 20% may still be directed by the SFBs to any PSL subsector where they have a competitive edge, but it's definitely a smaller flexible portion than before.
So a clear reduction in the overall PSL requirement for SFBs. It gives them more flexibility in their lending portfolio. This seems like the RBI trusts SFBs to manage broader risk more effectively now. It might free up capital for them to pursue, say, digital lending more aggressively, or perhaps specialize MSME segments, potentially intensifying competition with larger banks in those niches. It feels like a subtle push for more tailored financial inclusion solutions.
Exactly. It balances their mandate for financial inclusion with greater operational flexibility. It allows them to optimize their lending strategies while still ensuring a significant contribution to priority sectors. It's a recalibration.
Building on the theme of consumer protection, the RBI has also addressed an area that directly impacts almost every borrower's wallet: prepayment charges on loans. These often feel like a hidden cost, right? So I'm keen to understand the new directions here.
Yes, this is a vital area for consumer protection and, frankly, promoting a fairer lending environment. The RBI has been working towards ensuring affordable and flexible access to credit, particularly for micro and small enterprises, MSEs. These are, the small businesses and firms that are a significant part of the economy and often need specific financial support.
Right.
However, supervisory reviews highlighted, inconsistent practices among regulated entities regarding these prepayment charges.
What kind of inconsistencies were observed that led to this intervention? Were there specific complaints or patterns?
There were inconsistencies that led to customer complaints and disputes. But more importantly, they revealed the presence of restrictive clauses in some loan agreements. These were specifically aimed at discouraging borrowers from switching to other lenders, maybe for better terms or lower interest rates.
Ah, the lock-in effect.
Exactly. This was seen as detrimental to competition and consumer welfare, effectively trapping borrowers with one lender even if better options became available elsewhere.
So what's the concrete solution the RBI has put in place to address these concerns and foster a more competitive environment? Is there a new directive?
Yes. To address these concerns, the Reserve Bank of India Prepayment Charges on Loans Directions 2025 have been formally issued, and these new directions will take effect from January 1st, 2026.
Okay, January 1st, 2026. Who do these directions apply to and which loans are covered? Is it broad?
Very broad. They are applicable to virtually all major lending institutions, all commercial banks, but excluding payments banks, cooperative banks, non-banking financial companies, NBFCs, and all India financial institutions. And importantly, they cover all loans and advances sanctioned or renewed on or after January 1st, 2026. So any new or renewed loan from that date onwards will be subject to these new, more borrower-friendly rules.
Let's get into the specifics then. What's the rule for individuals taking non-business loans, like a home loan or a personal loan, for example?
Okay, for individuals taking non-business loans, the rule is quite clear. No prepayment charges shall be levied on floating rate loans. And this applies regardless of whether there are co-obligants on the loan.
No charges on floating rate loans.
Correct. And just to clarify, floating rate loans are those where the interest rate can change over the loan's term based on market conditions, unlike fixed rate loans where the rate stays the same. This is a significant relief for, say, home loan borrowers who might want to pay off their loan early or switch to a different lender without facing a penalty. It promotes greater financial freedom.
What about individuals and MSCs when it comes to business loans? This sounds like it might be a bit more complex, maybe depending on the lender type or loan size.
It does get a bit more nuanced here, yes, because there are different categories of regulated entities and loan sizes involved. So for business loans to individuals and micro and small enterprises, MSEs, first, no prepayment charges at all can be levied by most major commercial banks, but this excludes small finance banks, regional rural banks, and local area banks. It also applies to large primary urban cooperative banks, specifically Tier 4, and large non-banking financial companies, NBFC-ULs, the upper layer ones, and all India financial institutions also cannot levy these charges.
Okay, so the big players mostly can't charge.
Right. Then, for loans up to 50 lakh, no prepayment charges can be levied by small finance banks, regional rural banks, Tier 3 primary urban cooperative banks, state and central cooperative banks, and NBFC-MLs, that's NBFCs in the middle layer of regulation. This means for a significant chunk of small business loans, prepayment is now effectively free of charge.
That's a lot of detail, but super important for understanding which entities fall under which specific rules. So these rules apply regardless of the source of funds for prepayment, whether it's savings or refinancing, and there's no lock-in period. What about dual rate loans, the ones that combine fixed and floating elements? How do they fit in?
Yes, that's right. The source of funds for prepayment is irrelevant, and crucially, there's no lock-in period imposed before a borrower can prepay. For dual special rate loans, which, as you said, combine fixed and floating rates, the applicability of prepayment charges depends entirely on whether the loan is under the floating rate period at the time of prepayment.
Oh, okay.
So if it's in its floating rate period when the prepayment occurs, then the no-charge rule applies. Simple as that.
What if a loan type isn't explicitly covered by these new rules? Are there still scenarios where prepayment charges might apply? Or is it a blanket ban?
No, it's not a blanket ban. For other loan types not explicitly covered by these specific no prepayment charge provisions, charges may still apply, but only as per the regulated entity's board-approved policy.
Okay.
And there are specifics. For term loans, these charges must be based only on the amount actually prepaid. For cash credit or overdraft facilities, prepayment charges on closure before the due date can only be levied on an amount not exceeding the sanctioned limit, not, say, on the highest outstanding amount, which prevents excessive charging.
Are there any other scenarios where no prepayment charges apply, perhaps related to the lender's actions or specific circumstances?
Yes, there are two more specific situations. First, no prepayment charges are levied if the borrower informs the RE of their intent not to renew a cash credit or overdraft facility and subsequently closes it on its actual due date.
Makes sense.
Second, no charges apply if the prepayment is done at the RE's own instance, for example, if the bank decides to call back the loan for its own internal reasons.
Transparency is absolutely key here, isn't it? Especially with these charges that can often feel opaque or buried in the fine print.
Absolutely. The applicability of prepayment charges must be clearly and explicitly mentioned right in the sanction letter and the loan agreement provided to the borrower. It must also be included in the key facts statement, KFS, where applicable.
Right, the KFS.
And the key facts statement, KFS, just as a reminder, is that standardized document providing essential loan info clearly and concisely. Crucially, any undisclosed prepayment charges simply cannot be levied. Furthermore, REs are expressly barred from retrospectively levying fees or charges that had previously been waived at the time of prepayment. No backsies.
Good. So this whole set of directions repeals previous RBI instructions on the matter, But, importantly, those repealed circulars remain valid for the period before these new directions come into force on Jan 1, 2026. It sounds like a comprehensive update aimed squarely at greater fairness and transparency for borrowers.
It is, and it significantly enhances transparency and consumer choice in the lending market. It's particularly beneficial for individuals and small businesses who might have felt locked in before.
Okay, let's turn our attention now to the rapidly evolving world of financial markets, specifically electronic trading platforms, or ETPs. The RBI has issued new master directions here, signaling a pretty comprehensive regulatory approach to digital trading.
Yes, this is a crucial modernization of oversight. It reflects the increasing digitization of financial transactions across the board. The Master Direction Reserve Bank of India, Electronic Trading Platforms Directions 2025, these actually supersede earlier guidelines that were issued back in 2018.
Okay, so an update from 2018.
Right. They aim to regulate entities operating ETPs for various financial instruments. Think securities, money market instruments, foreign exchange instruments, and derivatives. An electronic trading platform, ETP, just for clarity, is essentially any electronic system other than a recognized stock exchange where transactions in these eligible financial instruments are contracted.
And these directions are effective immediately. What's the overarching goal here? Stability, transparency.
Yes, they are applicable with immediate effect. The overarching goal is really multifaceted. Ensure ETPs operate transparently, securely, and in a manner that protects public interest, while also strengthening the overall financial market infrastructure in India. It's about bringing a robust regulatory framework to a space that was perhaps less defined previously.
Are there any specific exemptions from these new broad directions? Are all electronic systems covered?
No, not quite all. These directions do not apply to electronic systems operated solely by a scheduled commercial bank, including a branch of a foreign bank operating in India, or a standalone primary dealer, provided, and this is the key condition such a system has, the entity itself as the sole price provider, and as a party to all transactions contracted on that system. However, even these exempted entities are still required to furnish data and reports to the RBI as specified, and the RBI retains the power to bring them under these directions if it's deemed necessary in the public interest.
Got it. So these new directions introduce a comprehensive regulatory framework. What's the foundational requirement for operating an ETP? Does it start with authorization?
First and foremost, yes. There's a mandatory RBI authorization required to operate an ETP for eligible financial instruments. This isn't an automatic process. It signifies the RBI's stringent oversight from the very beginning.
What are the key eligibility criteria for an entity looking to get this authorization? What boxes do they need to tick?
There are three key categories of criteria that entities must meet. First, general criteria. The entity must be an Indian incorporated company. Any shareholding by non-residents must conform to all applicable laws, including the Foreign Exchange Management Act, 1999, or FEMA. Additionally, the entity seeking authorization, or at least two of its key managerial personnel, must have a minimum of 3 years of experience in operating trading infrastructure in financial markets.
Experience is key.
Absolutely. Second, financial criteria. A minimum net worth of 5 crore is required, and this must be maintained continuously to demonstrate financial stability. And third, technological criteria. They must possess a robust IT infrastructure. This means capable of ensuring scalability, reliability, real-time data dissemination, and of course strong cybersecurity measures to protect sensitive financial information. They must be able to disseminate trade information on a real-time or near real-time basis that's crucial for market transparency.
And how does one actually apply for this authorization? And what are the RBI's powers once an application is submitted? Can they just say no?
Applications are submitted via the PRAV-AH portal, which is the RBI's centralized application portal for various regulatory approvals. The RBI can seek additional information, consult other authorities as part of its assessment, and yes, their decisions regarding approval, rejection, or even cancellation of authorization are final and binding.
Okay.
Importantly, authorization granted is non-transferable. It can be revoked for violations, though this is always subject to providing a fair hearing first. If authorization is canceled, the ETP operator must stop operations immediately, or as directed by the RBI, and surrender the original letter of authorization.
Let's talk about the detailed operating framework for ETPs now. How about access and participation for market members? What does the RBI expect in terms of fairness?
Okay, ETPs must establish fair and transparent membership rules. They're required to conduct due diligence when onboarding members and must identify members uniquely using a legal entity identifier, LEI, and/or permanent account number,
LEI and PAN.
Right,
Yeah.
exactly. And LEI is that 20-character alphanumeric code identifying legal entities and financial transactions. And PAN is the unique tax identifier. ETPs must also make pre-trade information, like bid-offer prices, and post-trade information price, volume, time of transactions, available to members on a fair and non-discriminatory basis. All governing rules and procedures must be freely available to participants. Transparency is paramount.
What about risk management? That's absolutely critical in trading platforms, especially from the RBI's perspective.
Couldn't agree more. ETPs must implement a comprehensive risk management framework. This includes robust internal controls to effectively manage both operational risks and trading risks. This specifically includes enforcing strict access controls, preventing unauthorized transactions, and implementing error prevention mechanisms within their systems. They also have to segregate the ETP operations from other financial services or infrastructure to prevent any unfair access. The operator must ensure that all trades on the system, without exception, are dealt with in a fair, non-discretionary, and orderly manner following established procedures. Robust pre-trade and post-trade controls are absolutely essential to achieve this.
And what if the ETP facilitates algorithmic trading, algo trading? I know that's becoming increasingly common and adds layers of complexity and speed. What are the rules there?
Right. If an ETP operator provides or facilitates participation by algorithmic trading systems, algo systems, and just to be clear, algo trading means any trade originated by a software program using automated execution logic. They have several obligations. First, they must put in place a clear framework for the testing and onboarding of these algo systems.
Okay, testing is crucial.
Very. Second, they must ensure that such facilities are offered transparently and non-discriminatorily to all eligible members. Third, they need to ensure their systems effectively manage the risks arising from algorithmic trading, including complex model risks. And finally, they must ensure that the personnel handling these algo systems have the necessary skills and competence.
What about handling unexpected events and disputes? Things go wrong sometimes in dynamic financial markets. How are ETPs expected to prepare for that?
Yes, they need a plan. An ETP operator is required to establish a clear set of rules and regulations to handle unexpected events. This includes scenarios like the suspension or cessation of trading, system malfunctions, maybe erroneous actions by members, or any other unforeseen circumstances. These rules must be transparent and well-defined to ensure smooth operations even in emergencies. Additionally, the operator must have provisions in place to effectively address disputes that might arise between its members.
Surveillance and conflicts of interest are also important for maintaining market integrity and, well, trust. How is that addressed?
Indeed. The operator must implement robust surveillance systems to ensure fair trading practices and maintain market integrity. These systems need to monitor trading activities both in real time and retrospectively. Furthermore, the operator is required to identify and disclose to the Reserve Bank any potential conflicts of interest, especially if related parties or group agencies are involved in the ETP's operations. Full disclosure is key.
And transparency in fees. Also, what are the rules for outsourcing their operations? That seems crucial for both fairness and accountability.
Yes, a transparent, non-discriminatory, and fair fee structure must be established and clearly communicated to all members. If the ETP operator chooses to outsource any of its operations, technology, or activities, it must ensure a robust governance and risk management framework is in place to manage these arrangements.
Right, they can't just pass the buck.
Exactly. Such outsourcing should not hinder compliance with RBI regulations, and the operator must maintain strict adherence to data preservation, access, and reporting requirements, even if the outsourcing agreement ends. The final responsibility for compliance always rests with the ETP operator.
Business continuity and security, these must be paramount for such platforms, given their critical role in the financial system. What are the specifics here?
Absolutely. A formal business continuity plan, BCP, and a comprehensive disaster recovery setup are required to ensure uninterrupted operations, even in adverse scenarios. Strict cybersecurity norms are mandated. Plus, robust IT audits are required, conducted by Certified Information System Auditor, CSA, or Indian Computer Emergency Response Team, certain and impaneled auditors.
Okay, specific auditors.
Yes. Additionally, ITBS audits are mandatory at least once a year. These measures, along with strict policies for outsourcing, are crucial to ensure that RBI compliance isn't compromised at any point.
And data governance, particularly how long data must be retained. What are the requirements for these platforms regarding data?
Data confidentiality and accessibility must be ensured, with access strictly controlled by the ETP operator. All data generated or collected must be preserved for a minimum of 10 years. Now, if there's an ongoing investigation, this data must be preserved for at least 3 years after the investigation concludes, if applicable. And upon cancellation of authorization or exit from operations, the RBI may direct the ETP operator to share the complete ETP data in a prescribed format.
Finally, stringent reporting requirements. What kind of data will ETPs need to submit to the RBI on a regular basis?
Okay, ETP operators must submit quarterly reports on platform functioning on or before the 15th day of the month following the quarter end to the RBI. Annual compliance reports are due to the Reserve Bank by April 30th of the succeeding financial year. They also have to report transaction data to trade repositories or as directed by the RBI. And crucially, they are obligated to notify the RBI immediately of any disruptions to their platform or any instances of market abuse they detect.
And what if an ETP wants to discontinue operations? Is that a straightforward process, or does the RBI maintain oversight right to the end?
They must seek prior RBI approval for the timing and conditions of termination. It's not just a unilateral decision. In such a case, the ETP operator must surrender their original authorization letter to the Reserve Bank. It's also important to note the RBI retains discretionary powers to exempt specific ETPs or classes from parts of these directions, perhaps based on public interest or financial stability needs. Authorization will be granted selectively, considering market robustness, systemic risks, and technology maturity. This is really a massive step towards regulating the digital trading space comprehensively, ensuring stability in what can be a volatile environment. It definitely creates a strong, clear framework for a rapidly evolving part of the financial market. Much needed.
Okay, this next point is truly significant, especially for large-scale development and infrastructure in India. The RBI has introduced major new norms for project finance. Now, this is a complex area, so let's take it step by step, focusing on the core shifts.
Yes, this is indeed a landmark set of directions. It reflects the RBI's commitment to sustainable lending and, infrastructure growth. The Reserve Bank have been progressively working towards creating a more principle-based resolution framework for stressed assets.
Right.
And just for context, stressed assets are those borrowed funds that are at risk of default or are already showing signs of financial distress, meaning the borrower has stopped or delayed repaying the debt. Project finance, on the other hand, is that method of funding a project where the revenues generated by the project itself serve as the primary security for the loan and a main source of repayment. It can be for new installations, greenfield projects, or improvements to existing ones, brownfield projects.
So what was the specific background for these new rules? What gaps did the RBI identify in the previous framework for project finance that needed addressing?
Well, a significant step in stress resolution was the introduction of the Prudential Framework for Resolution of Stressed Assets back in 2019. However, that framework didn't specifically cover restructuring related to projects under implementation, where the deed of commencement of commercial operations, DCCO, had changed.
Ah, the DCCO delays.
Exactly. The original DCCO is the date, envisaged right at financial closure, by which a project is expected to be commercially operational. And financial closure itself is that point when the project's capital structure, equity, debt, grants, covering at least 90% of the total cost becomes legally binding.
Why was that a specific issue not adequately covered before? Why is a delay in DCCO treated differently than other types of financial stress?
That's a good point. Delays in DCCO don't always reflect financial stress or, borrower default in the traditional sense.
Yeah.
In sectors like infrastructure, for instance, delays are quite common and often beyond the borrower's control. Think regulatory clearances, land acquisition issues, even global supply chain disruptions.
Yeah, external factors.
Exactly. The RBI wanted to treat such genuine, non-default related delays more leniently and avoid automatically classifying those accounts as non-performing assets, NPAs, under the strict 90-day overdue norms. Just to remind listeners, NPAs are loans where principal or interest payment remained overdue for 90 days.
So these new directions are meant to address that gap and provide a more nuanced, perhaps more realistic approach to project delays while still maintaining financial discipline.
Precisely. The Reserve Bank of India Project Finance Directions 2025 provide a uniform framework for project financing across both infrastructure and non-infrastructure sectors. This includes commercial real estate, CRE, and CRE residential housing, CRERH. They also lay out a revised regulatory treatment for changes to the DCCO based on an updated understanding of the associated risks and, frankly, market realities.
When do these directions come into effect and who do they apply to? Is it a broad application across the financial sector, covering most lenders?
Yes, very broad. They'll come into effect from October 1st, 2025. They're binding on a wide range of regulated entities, which we'll just call lenders from now on. This includes all commercial banks, but explicitly excluding payments banks, local area banks, and regional rural banks, all non-banking financial companies, NBFCs, including housing finance companies, all primary urban cooperative banks, and all India financial institutions, AIFI. So yes, it's a very broad application, ensuring consistency across the board.
Let's get to the quick summary of these directions then. What are the key highlights that borrowers and lenders should really understand from this?
Okay, the key points really boil down to these. First, the adoption of a principle-based regime for resolving stress and project finance exposures. This is harmonized across all REs, meaning less rigid rules and more room for commercial judgment, guided by principles. Second, a rationalization of permissible DCCO extensions. There are now overall ceilings: 3 years for infrastructure projects and 2 years for non-infrastructure sectors. This provides clear outer limits for delays. Second, a rationalization of permissible DCCO extensions. There are now overall ceilings. Third, flexibility for REs in extending DCCO within these ceilings based on their commercial assessments rather than strict, arbitrary time-bound rules that don't always account for project realities. Second, a rationalization of permissible DCCO extensions. There are now overall ceilings. Fourth, a rationalization of standard asset provisioning requirements, specifically 1% for projects under construction. Now, this provisioning will gradually increase for each quarter of DCCO deferment, incentivizing timely completion. Second, a rationalization of permissible DCCO extensions. There are now overall ceilings. Fifth, for under construction commercial real estate CRE exposures, the provisioning requirements will be slightly higher at 1.25%, acknowledging the distinct risk profile of that sector. Second, a rationalization of permissible DCCO extensions. There are now overall ceilings. Crucially, projects where financial closure has already been achieved before the effective date will continue with the existing provisioning norms. This ensures a seamless implementation without disrupting ongoing projects. And finally, during the operational phase, after repayment has started, the standard asset provisioning reduces significantly: 1% for CRE, 0.75% for CRH, and just 0.40% for all other project exposures. This acknowledges the lower risk profile once a project is actually generating revenue.
What about accounting standards and scope exclusions? Are there any projects or entities that fall outside these new directions entirely?
Good question. For NBFCs that follow INDIAS, that's Indian Accounting Standards, they must additionally comply with these directions concerning provisioning and other regulatory requirements over and above INDIAS. Importantly, these new directions will not apply to projects that achieve financial closure as on October 1st, 2025.
Okay, so existing projects are grandfathered.
Essentially, yes. Those existing projects will remain governed by the previous guidelines. However, if there's any new credit event or a change in material terms and conditions in such already closed projects after the effective date, then they must follow the 2025 directions. Lastly, loans that don't meet the definition of project finance or loans where the projects are already operational will continue to be governed by the general prudential framework or other applicable instructions based on the lender category.
So to apply appropriate prudential guidelines, projects are divided into 3 distinct phases. Can you walk us through those phases quickly?
Yes, that's right. For applying these guidelines correctly, projects are viewed in 3 distinct phases. First is the design phase. This starts right from the conception of the project and includes its design, planning, getting approvals, clearances, right up to the point of financial closure. Second is the construction phase. This kicks off immediately after financial closure and continues until 1 day before the actual DCCO. Remember, the actual DCCO is when the project is put to commercial use and gets its completion certificate. If the original DCCO gets revised, it becomes the extended DCCO, and finally, the operational phase. This begins on the actual DCCO and extends until the entire project finance loan is fully repaid.
What are the prudential norms for actually sanctioning project finance under these new directions? What do lenders need to ensure before they commit funds?
Okay, lenders must update their credit policies to incorporate these new provisions first. Then, before any funds are dispersed, a few key things must happen. Financial closure must be achieved, and the original DCCO must be explicitly documented. The disbursement schedule needs to align precisely with the stage of project completion, be in sync with equity infusion, and the repayment schedule post-DCCO must be realistic, accounting for the project's initial cash flow ramp-up phase.
Makes sense.
Also, the total loan tenure, including any moratorium period, must not exceed 85% of the project's estimated economic life. That's the number of years the project is expected to generate revenue. And importantly, for any given project, the original, extended, or actual DCCO must be consistent across all lenders involved in the financing.
And what about minimum exposure norms for lenders? This sounds new. Is this a way to spread risk more effectively across the consortium of lenders?
Yes, this is indeed a new and important provision. It aims to diversify risk and ensure a commitment from all participating lenders. Here's how it works. For under-construction projects where the total exposure by all lenders is up to 1,500 crore, no individual lender can have an exposure of less than 10% of the total exposure. For projects where the total exposure exceeds 1,500 crore, each lender must have a minimum exposure of either 5% of the total or 150 crore, whichever is higher. This structure ensures that no single lender has a disproportionately small stake, especially in larger projects, fostering collective responsibility and oversight.
Do these minimum exposure norms apply after the project is operational, or are they specifically for the construction phase when risks are generally higher?
No, that's a good clarification. These minimum exposure requirements do not apply after the project reaches its actual DCCO. Once the project is operational, lenders may then freely buy or sell their exposures under the RBI's existing master direction on transfer of loan exposures. Before the actual DCCO, transfers are allowed, but only under a syndication arrangement, and provided the minimum exposure criteria are still met after the transfer.
What about clearances and approvals before financial closure? Is everything needed right up front, or can some approvals come later in the process?
Lenders must ensure that all necessary approvals and clearances relevant to the project's implementation and construction are obtained before financial closure. This includes things like environmental, legal, and other regulatory clearances, depending on the project's nature. However, it's important to note that some approvals are inherently milestone-based and aren't required up front. For example, a boiler operation consent only becomes relevant after the boiler is built. Such approvals are not treated as mandatory prerequisites for financial closure.
And a crucial point for developers. What are the minimum land or right-of-way requirements before funds can actually be dispersed? This often trips up projects.
Yes, this is a crucial prudential condition. Lenders must verify that the project has acquired sufficient land or right-of-way before any funds are dispersed. The minimum thresholds are. For public-private partnership, PPP, infrastructure projects, remember, a PPP model is that cooperation between public and private sectors, at least 50% of the land or right-of-way must be available. For other projects, including non-PPP infrastructure and all non-infrastructure projects like commercial real estate, CRE, and CRE residential housing, CRERH, at least 75% availability of land or right-of-way is required. Interestingly, for transmission line projects, the requirement is left to the lender's discretion, perhaps recognizing the unique challenges there.
How do PPP model disbursement conditions work specifically? Are there any unique requirements due to the public-private nature of these deals?
Yes, for PPP infrastructure projects, the disbursement of funds must begin only after the appointed date, or its equivalent is officially declared by the concessioning authority, usually a government body. However, there's a nuance. Lenders may sanction non-fund-based credit facilities, think bank guarantees or letters of credit, if these are explicitly mandated by the concessioning authority as a precondition to declaring the appointed date. Such sanctions must, of course, comply with existing RBI guidelines on non-fund-based facilities.
What if the appointed date itself changes before disbursement begins? Can the original DCCO be adjusted to reflect that?
Yes, if the appointed date is changed by the concessioning authority before any fund disbursement has occurred, the original DCCO, as per the financial closure document, can be updated through a supplementary agreement. But this change isn't automatic. It must include a reassessment of the project's viability, formal approval or sanction from competent authorities, and importantly, a fresh techno-economic viability TEV study if the aggregate exposure by all lenders is 100 crore or more.
And the actual disbursement of funds, is it a lump sum payment or is it stage-aligned and needs certification?
It's definitely stage-aligned. Disbursement of funds must be proportional to the stage of project completion. It must also be in sync with the agreed equity infusion schedule and other sources of finance, and always subject to the receipt of any remaining necessary clearances. The stage of completion must be certified by the lender's independent engineer, LIE, or an architect. Just a reminder, an LIE is that independent expert appointed by lenders to monitor progress and certify these completion stages.
When can a project finance account be classified as an NPA, a non-performing asset, even before the project actually starts commercial operations? Is that possible?
Yes, it is possible. A project finance account may indeed be classified as an NPA even before the actual DCCO, if such classification is warranted by the actual record of recovery, or lack thereof. This must be done in line with the Master Circular on Prudential Norms on Income Recognition, Asset Classification, and Provisioning, dated April 1st, 2025, or other relevant regulatory instructions applicable to specific lender categories. It's about recognizing genuine financial distress, regardless of the project's physical completion status.
And what if a credit event occurs during the construction phase? Does that trigger a collective response from all the lenders involved?
Yes, it does. If a credit event occurs during the construction phase with any lender involved in the project, it triggers a collective resolution process guided by the Prudential framework. The term default in the context of project finance is specifically interpreted as credit event here. And a credit event is deemed to have occurred upon default with any lender, or if a lender determines a need for DCCO extension or additional debt infusion, or if the original extended DCCO expires, or if the project faces financial difficulty as defined under the Prudential framework.
What are the reporting requirements when such a credit event occurs? Is there a central database for this kind of information?
When a credit event occurs, the lender must report it to the Central Repository of Information on Large Credit, CRILC. This reporting happens through both weekly and CRILC main reports, as per existing instructions. Remember, CRILC is that RBI database monitoring large credit exposures. Additionally, the lender must immediately inform all other lenders involved in the consortium or multiple lending arrangement about this credit event. Specific CRILC reporting guidelines related to this new framework will be issued separately to streamline the process.
There's a review period of 30 days after a credit event is reported. What happens during this period, and what's the ultimate goal?
During this 30-day review period, the lenders must undertake a preliminary review of the account. Actions like signing an intercreditor agreement, ICA, that's a legal agreement between lenders outlining how they'll act collectively, and deciding on implementing a resolution plan, must follow the timelines laid out in the Prudential framework, unless stated otherwise in these new directions. The goal is to ensure a coordinated and timely response to the stress, aiming for a resolution rather than letting it slide into a worse state.
Can an account remain classified as standard even with a DCCO extension approved in the resolution plan, or does any delay automatically trigger a downgrade?
Yes, it can remain standard. If the resolution plan involves the DCCO extension, the account can retain its standard classification provided several conditions are met. The account must have been standard before the resolution process was initiated. It must meet all the specific prudential conditions outlined in Chapter 3 of these directions, and the resolution plan itself must be aligned from its inception with the RBI specified parameters for such extensions.
What are the maximum permissible DCCO deferment limits then? How long can a project be delayed while still being considered standard under these new rules?
Okay, the resolution plan can involve deferring the DCCO along with a proportional shift in the repayment schedule, but it must adhere to strict overall limits from the original DCCO. For infrastructure projects, the maximum deferment allowed is up to 3 years. For non-infrastructure projects, which include CRE and CRERH, the maximum deferment allowed is up to 2 years. These are hard caps designed to prevent indefinite delays while allowing reasonable flexibility.
What about financing cost overruns while keeping the account standard? Projects often incur additional costs during delays, which can be a major headache for everyone involved. How is that handled?
Right, cost overruns are common. A cost overrun related to the permitted DCCO deferment can indeed be financed, and the account can still be classified as standard, but subject to specific conditions. The cost overrun must be within 10% of the original project cost, and this calculation excludes any interest during construction, ITC. It must be funded through a standby credit facility, SBCF, that was approved right at the time of financial closure. Remember, an SBCF is that contingent credit line specifically set up to fund potential cost overruns during construction.
Okay, what if there's no SBCF or it wasn't renewed?
Good point. For infrastructure projects specifically, if an SBCF wasn't sanctioned or wasn't renewed, any additional funding provided to cover the overrun must be priced at a premium. This premium should be relative to what would have been charged on a pre-sanctioned SBCF, clearly defined in the loan contract, and potentially revised upward based on actual risk. Also, after this cost overrun funding, key financial parameters like the debt-to-equity DE ratio and any external credit rating must either remain unchanged or actually improve in favor of the lender. The DE ratio, just to remind, shows a proportion of equity versus debt financing. For smaller projects where the aggregate exposure of all lenders is less than 100 crore, an internal credit rating might be considered if the project wasn't originally rated externally.
Can a change in the project's scope or size also lead to a DCCO deferment while retaining the standard classification, or is that treated as a separate scenario requiring different conditions?
Yes, a project finance account can retain its standard classification even if there's a DCCO deferment due to a substantial increase in the project's scope or size, but again, subject to all the following conditions being met. The increase in project outlay, excluding any cost overruns, must be significant at least 25% of the original project cost. The lender must re-evaluate the project's viability thoroughly before approving any enhancement in scope and setting a new DCCO. If the project was already rated externally, the new rating must not fall more than one notch below the previous rating. If the project was unrated and the total lender exposure is 100 core or more, it must obtain an investment-grade external rating after the increase in scope or size. And finally, this specific benefit related to a change in scope can be availed only once during the entire lifetime of the project.
What are the implementation requirements for these resolution plans? How quickly must these changes be formalized in documentation and books?
Okay, for a resolution plan, including those involving DCCO deferment, to be deemed successfully implemented, several things must be completed within 180 days from the end of that 30-day review period. All necessary agreements between the lender and the debtor must be fully executed. Security charges must be created, and the perfection of securities must be achieved as per the resolution plan. Additionally, the revised capital structure and any changes in the financing agreements must be properly reflected in the books of both the lenders and the debtor.
And the consequences if implementation fails. What happens if these plans aren't executed within that 180-day timeframe? Is there a penalty?
Yes, there's a strict consequence. If the resolution plan involving DCCO changes is not successfully implemented within the stipulated time, the account must be immediately classified as NPA, non-performing asset, irrespective of its previous classification. This acts as a strong incentive to ensure timely and effective implementation of agreed-upon resolution plans.
How does asset classification upgradation work? Say an account was downgraded to NPA due to non-compliance with these rules. Can it become standard again?
It depends on the reason for the downgrade. If a project finance account was downgraded to NPA due to non-compliance related to the resolution conditions, like exceeding deferment limits, it may be upgraded back to standard only after the project demonstrates satisfactory performance after the actual DCCO. However, if the downgrade was simply due to non-compliance related to documentation and structural alignment within the resolution plan implementation timeline, the account can be upgraded back to standard upon successful implementation of that plan, provided there's no fresh request for further DCCO deferment at that point.
What about income recognition guidelines for these project loans? Does it change depending on whether the asset is standard or NPA?
Yes, it does. Lenders may recognize income on an accrual basis for project finance exposures that are classified as standard. However, for exposures classified as NPA, income recognition must strictly follow the guidelines in the Master Circular on Prudential Norms dated April 1st, 2025, or other relevant guidelines applicable to specific lenders. Generally, this means income recognition happens only on a cash basis for NPAs.
And the detailed provisioning norms for standard assets. This is a key part of risk management for banks, right? Can you break down the percentage requirements based on phase and type?
Absolutely. Lenders must maintain general provisioning for project finance exposures on a portfolio basis, and the rates vary. During the construction phase. For commercial real estate CRE projects, the provisioning is 1.25% during the construction phase. For commercial real estate residential housing, CRE-projects, it's 1.00% during the construction phase. For all other project finance, like infrastructure, it's also 1.00%. Then, during the operational phase, after repayment starts. Then during the operational phase, after repayment starts. For CRA projects, the provisioning reduces to 1.00%. Then during the operational phase, after repayment starts. For CRH projects, it drops further to 0.75%. Then during the operational phase, after repayment starts. And for all other project finance, it's the lowest at 0.40%. Furthermore, for standard accounts where the DCCO has been deferred under a resolution plan, there's additional provisioning mandated per quarter of deferment. This is over and above the standard asset provisioning. The specific rates for this additional provision are 0.375% for infrastructure projects and 0.5625% for non-infrastructure projects, including CRE and CRERH. These additional provisions, however, will be reversed once the project actually commences commercial operations.
What about provisioning for existing projects? Those that achieved financial closure before these new rules came into effect on October 1st, 2025. Are they completely exempt?
Projects that achieve financial closure prior to October 1st, 2025 are exempt from these specific new provisioning rules outlined just now. They will continue to be governed by the existing prudential provisioning guidelines that were applicable to them before, which are otherwise being repealed under this new framework.
Okay, but is there a catch?
There is. However, if such existing projects undergo a resolution of a fresh credit event and/or a significant change in the material terms of their loan contract after the effective date, then the new provisioning norms will apply to them as if the loans were sanctioned after the effective date. And of course, for any project loans that become non-performing assets, provisioning must always be done as per the general NPA norms, regardless of when financial closure occurred.
Finally, what are the operational and compliance-related provisions? What do lenders need to actually do to adhere to these new project finance rules?
Lenders must create and maintain a project-specific database. This needs to be in an electronic and easily accessible format. Updates to project data must be made promptly, but no later than 15 days after any change occurs. The required systems and processes to support these directives must be established by the lenders within 3 months of the October 1st, 2025 effective date. And the RBI makes it clear, any violation of these directions will result in supervisory and enforcement actions, with the nature of such action based on applicable regulatory provisions. With these directions coming into force, all previous instructions or guidelines specifically on project finance stand repealed as of their effective date.
That was an incredibly detailed look at project finance. This really highlights the RBI's commitment to both promoting essential infrastructure and ensuring financial stability by bringing much-needed clarity and stricter yet more flexible risk management. It's a massive effort to standardize and de-risk a critical area of lending.
Indeed, it's a very comprehensive framework. It aims to foster both growth and prudence in what is undeniably a vital sector for the Indian economy.
Let's shift gears now to investments. The RBI has revised guidelines on investments by regulated entities in alternative investment funds, AIFs. What's the core intent behind these revisions? Why now?
Yes, these are the Reserve Bank of India Investment in AIF Directions 2025. Essentially, they are a review and update of existing guidelines concerning investments made by regulated entities, AIEs, in alternative investment funds. An alternative investment fund, AIF, just for context, means any privately pooled investment vehicle set up in India that collects funds from sophisticated investors, not retail investors, to invest according to a defined investment policy.
Okay.
The core intent behind these revisions seems to be ensuring prudent investment practices by these REs and preventing potential issues like regulatory arbitrage or hidden risks associated with complex, often opaque investment structures involving AIFs.
When do these new rules come into force? Is there a lead time?
Yes, they shall come into force on January 1st, 2026. However, the RBI provides some flexibility, stating they can come into force on an earlier date if adopted by a regulated entity through its own internal policy. These directions really aim to enhance regulatory clarity and ensure prudent investment practices by REs in this space.
Who do these directions apply to specifically regarding investments in AIF schemes? Is it just banks or a broader set of financial institutions?
It applies to a broad range of REs investing in units of AIF schemes. This includes commercial banks, and that covers small finance banks, local area banks, regional rural banks, primary urban cooperative banks, state cooperative banks, and central cooperative banks, all India financial institutions and non-banking financial companies and BSCs, including housing finance companies, HFCs. So yes, essentially any major financial institution under RBI oversight that might invest in AIFs.
What's the general requirement for RDs when it comes to AIF investments now? Is it just about following rules, or does it require a more strategic approach internally?
It requires a more strategic approach. Every regulated entity must now incorporate clear provisions in its own investment policy that specifically govern its investments in AIF schemes.
Yeah.
This policy must ensure compliance with all applicable laws and regulations. So a formalized internal framework is now mandatory, requiring REs to strategically think about, document, and get board approval for their approach to AIF investments.
Now, the crucial part, limits on investments and provisioning requirements. What are the caps for REs investing in AIFs? Are there restrictions?
Yes, there are both individual and collective caps being put in place. An individual RE cannot invest more than 10% of an AIF scheme's total corpus. Additionally, the total contribution from all REs combined in any single AIF scheme is capped at 20% of the corpus of that particular scheme. These limits are clearly designed to prevent overexposure of regulated entities to potentially higher risk alternative investments and maintain systemic stability.
And a significant provisioning norm, especially if there's a connection between the AIF's investment and a debtor company of the RE. This sounds like it might be designed to prevent the evergreening of loans through complex structures.
Yes, this is a very important prudential measure, and you're right, it seems directly aimed at preventing circular financing or evergreening. Here's how it works. If an RE invests over 5% of the corpus of an AIF scheme, and that scheme has downstream investments, but specifically excluding equity instruments, and a debtor company of that same RE, where a debtor company is any company the RE has lent to or invested in, excluding equity, anytime in the last 12 months, then the RE must make 100% provisioning.
100%. Wow.
Yes, 100% provisioning equivalent to its share of investment in that debtor company made through the AIF. However, this provisioning is limited to the amount of its direct exposure to that company. Just to clarify, equity instruments here include equity shares, compulsorily convertible preference shares, CCPS, and compulsorily convertible debentures, CCD. This rule effectively makes it very costly from a capital perspective for an RE to fund an AIF that then turns around and invests in or lends to a company that already owes the RE money.
What if the RE's investment is via subordinated units in the AIF? Does that carry an even higher capital charge, given the higher risk?
Yes, it does. If the RE's investment is via subordinated units, meaning units that bear higher risk than other units in the AIF structure and are typically the first to absorb losses, the entire amount of this investment shall be deducted directly from its capital funds. This deduction will be made proportionately from Tier 1 and Tier 2 capital, wherever applicable. It essentially treats it like a higher risk exposure for capital calculation, reflecting the greater risk borne by such subordinated units.
Are there any exemptions from these new limits, or are they universally applied to all AIF investments by RE?
Yes, there are a couple of exemptions. Grandfathered investments, which are investments or commitments made by RE with prior RBI approval under an older directive, Master Direction Financial Services, provided by banks 2016, are explicitly excluded from these new limits. Additionally, the RBI, in consultation with the Government of India, may issue specific notifications to exempt certain AIFs from the existing circulars and these revised directions, although that general requirement to have a clear internal investment policy will always remain applicable.
And how do these new directions affect existing commitments made before these rules came into play? Do REs need to unwind those existing arrangements?
No, not necessarily unwind. Investments made by an RE on the issuance date of these directions in AIF schemes where commitments were fully honored will continue to be governed by the existing circulars. However, for investments made under an existing commitment as of the issuance date or a new commitment made prior to the effective date, Jan 4th, 2026, the RE actually has a choice.
The choice. Okay.
Yes, it can opt to follow either the provisions of the existing circulars or the provisions of these revised directions, but importantly, it must apply one framework completely to that specific investment or commitment. No mix-and-match approach is allowed, ensuring regulatory consistency for those specific legacy commitments.
Okay, another critical regulatory update concerns Basel III, capital regulations, and the inclusion of a new external credit assessment institution, ECAI, TRE. This is all about how banks manage their capital adequacy and risk assessment, right?
Precisely. This gets into the mechanics of how banks assess risk for capital adequacy purposes, which fundamentally affects how much capital they must hold against their assets. Under Basel III, that international regulatory framework setting standards for capital, stress testing, liquidity risk, etc., banks in India are permitted to use ratings from select international credit rating agencies.
Right.
This is specifically for risk weighting their claims on various foreign entities. These ratings help determine how much capital banks need to hold against these international exposures to ensure their financial stability.
Which agencies were allowed previously for this specific purpose, and what's the significance of adding a new one to the list?
Previously, 3 globally recognized agencies were allowed for this specific purpose: Fitch, Moody's, and Standard & Poor's. Their ratings were used to determine the risk weights applied to banks' claims on foreign entities, directly influencing the capital banks had to hold against those exposures. The significance of adding a new one is that it provides banks with more options, potentially fostering competition among rating agencies, and crucially, it recognizes a domestic entity in this critical assessment process for certain types of foreign exposure.
So what's new now? Who is the new ECAI joining this select list?
The RBI has now included Miscarriage Global IFSC Limited as an eligible external credit assessment institution under the Basel III framework.
Just a reminder, an ECI is simply a credit rating agency whose ratings banks can use to determine risk weights for capital calculation.
This means banks can now use their ratings, but specifically for certain types of exposures originating from the IFSC, is that right?
Exactly. Banks can now use ratings issued by CareEdge Global IFSC Limited for risk weighting their claims on non-resident corporates that originate specifically from the International Financial Services Center, IFSC. Remember, the IFSC is that special economic zone in India designed as a global financial hub. So this move expands the list of recognized rating agencies for these specific IFSC-originated foreign exposures from 3 to 4, enhancing flexibility and, importantly, recognizing domestic capability in credit assessment for these transactions.
Can you give us an idea of the risk weight mapping for CareEdge Global IFSC Limited's ratings? How do their ratings translate into capital requirements for banks, similar to the established ones?
Certainly. The mapping provided by the RBI is consistent with the standard Basel III approach to ensure comparability. For example, a top-tier rating like AAA from CareEdge Global IFSC translates to a 20% risk weight. An A rating gets a 30% risk weight. An A rating gets a 50% risk weight. A BBB rating results in a 100% risk weight, and ratings of DB and below attract a higher 150% risk weight. This provides a clear and standardized framework for banks using this newly recognized ECAI for their IFSC-based foreign corporate exposures.
Let's transition now to a series of surveys and indices that give us a crucial pulse on the Indian economy. These often provide insights beyond the headline numbers. Let's start with consumer confidence and inflation expectations.
Absolutely. These surveys are vital inputs for monetary policy formulation. They help the RBI understand sentiment on the ground, which can be a leading indicator. The RBI regularly conducts 3 key surveys in this area, giving them a rich, qualitative view to complement the hard data.
First, the Rural Consumer Confidence Survey, RCCS. What does it aim to capture specifically from rural and semi-urban India?
Okay. The RCCS is conducted every 2 months. It collects current perceptions and, importantly, 1 year ahead expectations of households residing in rural and semi-urban areas. This covers 31 states and union territories, so it's quite broad. The survey gathers views on the general economic situation, the employment scenario, the overall price situation, inflation, and households' perceptions of their own income and spending patterns. This provides crucial insights into the economic well-being and outlook of a very large segment of India's population. The July 2025 round is currently being launched, and the RBI has engaged its Development and Research Services, PVT Ltd, New Delhi, to conduct this particular survey round.
Then there's the Inflation Expectations Survey of Households, IESH. This seems absolutely critical for understanding where people think inflation is headed.
Yes, the IESH is key for that. It also aims at capturing subjective assessments on price movements and inflation, but based on individuals' own consumption baskets. This is done across 19 major cities, including places like Ahmedabad, Bengaluru, Delhi, Mumbai, Kolkata, Chennai, Hyderabad, Jaipur, and others.
Okay, major urban centers.
Primarily, yes. It seeks qualitative responses from households on expected price changes for both the 3 months ahead and the 1 year ahead period. It also asks for quantitative responses on current inflation, 3 months ahead inflation rates, and 1 year ahead inflation rates. This helps the RBI gauge public expectations, which we know can sometimes become self-fulfilling. The July 2025 round is also being launched now, and it's also being conducted by Emansys Development and Research Services, PVT Ltd, New Delhi.
And the Urban Consumer Confidence Survey, UCCS. This sounds like it complements the rural survey, giving a more complete picture of national sentiment.
Exactly. The UCCS is also conducted every 2 months and covers the exact same 19 cities as the IESH. It seeks qualitative responses from urban households regarding their sentiments on the general economic situation, the employment scenario, the price level, and crucially, their household's income and spending plans. This provides vital data on urban consumer sentiment, balancing out the rural perspective from the RCCS. And yes, the July 2025 round of this survey is also being launched now, again by Emansys Development and Research Services, PVT Ltd, New Delhi.
Okay, so all 3 surveys, RCCS, IESH, and UCCS, provide these crucial inputs for monetary policy formulation. They help the RBI understand sentiment on the ground, which can sometimes be just as important, if not more so, than the hard economic numbers themselves.
Precisely. They provide valuable qualitative and quantitative data that complements the traditional economic figures, offering a much more holistic view for policymakers trying to make sense of a complex economy.
Now, for something perhaps more concrete related to the economy, the All India House Price Index, HPI, for Q4.20/12/25, how is this index compiled, and what does it tell us about the health of the housing market?
Right, the HPI.
The RBI compiles this quarterly HPI using 2010-11-100 as the base year. It covers 10 major cities: Mumbai, Delhi, Chennai, Kolkata, Bengaluru, Lucknow, Ahmedabad, Jaipur, Kanpur, and Kochi. Based on the data from these cities, an average all-India HPI is also compiled.
And the data source.
Importantly, these indices are based on official data of property price transactions collected directly from the registration authorities of the respective state governments. This gives them a strong foundation in actual market activity, not just listings or estimates. It's a key indicator of real estate price trends across major urban centers.
What are the latest findings for Q4.2024-25? Are house prices generally stable, rising, or falling across India, according to this index?
Okay, the all-India HPI increased by 3.1% year-on-year in Q4.2024-25. Interestingly, this is the exact same growth rate, 3.1%, as recorded in the previous quarter, which suggests a relatively stable national trend. However, it does represent a slight drop from the 4.1% growth observed a year ago in Q4.273-24.
Any variation across cities?
Oh, absolutely.
Yeah.
The annual HPI growth varied widely across the individual cities. It ranged from a high growth of 8.8% Kolkata down to a contraction of 2.3% in Kochi. On a sequential basis, that's quarter on quarter, the all-India HPI increased by 9% in Q4.2024-25 compared to Q3.
This provides a really detailed picture of the housing market dynamics across the country. It shows both stability at the aggregate level, but also significant regional variations, which is fascinating. It highlights how localized real estate markets can be.
Indeed. It underscores the diverse real estate conditions and the impact of local market forces at play in different parts of the country.
Moving now to some business and services surveys. The RBI conducts the survey on international trade in banking services, ITBS. What exactly does this survey cover? What kind of information does it yield?
This survey, the ITBS, has actually been conducted annually since way back in 2006-07. It provides crucial information on financial services rendered internationally. Specifically, it looks at services provided by branches, subsidiaries, or joint ventures of Indian banks operating abroad, and also by branches and subsidiaries of foreign banks operating in India.
Okay, so cross-border banking services.
Exactly. The data is based on explicit or implicit fees and commissions charged to customers for these services. The 2024-25 round of this survey has just been launched, continuing this important data collection exercise that really informs our understanding of India's integration into global financial services.
And the quarterly order books, Inventories and Capacity Utilization Survey, OBICUS. This sounds critical for gauging the health and activity levels in the manufacturing sector.
Yes, OBICUS is very important for manufacturing. It's been conducted quarterly since 2008. It collects quantitative data directly from manufacturing companies on several key metrics: new orders received during the reference quarter, the backlog of orders at the beginning of the quarter, pending orders at the end of the quarter, and total inventories, with a useful breakup between finished goods, work in progress, and raw material inventories held at the end of the quarter.
Does it also measure production?
It does. It captures item-wise production in terms of both quantity and value during the quarter, comparing it against the installed capacity. It also asks for reasons for any changes observed. From all these responses, the RBI estimates the overall level of capacity utilization in the manufacturing sector, which provides very valuable input for monetary policy formulation. 70th round of this survey has just been launched for the reference period April-June 2025, Q1.2025-26.
Finally, the Quarterly Services and Infrastructure Outlook Survey, SIOS. What kind of insights does this particular survey provide, focusing on non-manufacturing?
Right, ECAI focuses on services and infrastructure. It assesses the business situation for the current quarter from selected companies in these sectors in India. It also captures their expectations for the ensuing quarter. It gathers qualitative responses, so more sentiment based on aspects like demand conditions, financial conditions, employment conditions, and the price situation within these sectors.
So it's forward-looking.
Yes, it offers a valuable forward-looking perspective on these key non-manufacturing sectors. The 46th round of SIOS, covering the reference period July-September 2025, has been launched. And for this round, Ms. Genesis Management and Market Research PVT Ltd. has been authorized by the RBI to conduct the survey.
Okay, so these various surveys, OBICUS, ACS, ITBS together, they paint a detailed picture of the ground realities across different sectors, providing critical data points for policy decisions and helping policymakers anticipate future economic trends.
They are absolutely essential for evidence-based policymaking. They help understand the nuances of economic activity that aggregate data might miss.
Let's delve now into the digital payment landscape, which is, as we know, constantly evolving at a rapid pace in India. First up, there's a directive on the due diligence of Aadhaar-enabled payment system, APS, touchpoint operators. This sounds like it's all about securing our digital transactions at the grassroots level.
Yes, this is squarely focused on strengthening security in digital transactions and protecting consumers, especially those using APS. The Aadhaar-enabled payment system, AePS, is a payment system operated by the National Payments Corporation of India, NPCI. It enables basic financial transactions using just an Aadhaar number and biometric or OTP authentication.
What kind of transaction?
It offers financial services like cash withdrawal, cash deposit, fund transfers, and also non-financial services like getting a mini statement or checking your balance inquiry. Now, an AePS touchpoint is the terminal could be mobile or fixed, deployed by acquiring banks. These are the banks that onboard the operators. And these touchpoints facilitate the AePS transactions. The ATO, or AePS touchpoint operator, is the individual person onboarded by the acquiring bank who actually operates that AePS touchpoint, often in a small shop or kiosk.
What's the background for these new directions here? Were there specific issues or vulnerabilities identified that prompted this regulatory intervention?
Yes, unfortunately. In recent times, there have been reports of frauds being perpetuated through AePS. Often this involves identity theft or the compromise of customer credentials at the touchpoint level. So to protect bank customers from such frauds, and, equally importantly, to maintain trust and confidence in the safety and security of the entire AePS system, the RBI felt a strong need to enhance the robustness of AePS operations, particularly around the operators themselves.
So what's new to address this? What are the specific measures, and when do these enhanced security requirements take effect?
Okay, to streamline the process for onboarding these AePS touchpoint operators and significantly strengthen fraud risk management, the Reserve Bank of India has issued the RBI Aadhaar-enabled payment system, AePS due diligence of AePS touchpoint operators directions 2025. These directions are set to come into effect from January 1st, 2026.
What are the key due diligence requirements for these AePS touchpoint operators, ATOs, specifically during the onboarding process? What must the acquiring banks do now?
Okay, for onboarding due diligence, the acquiring bank must conduct thorough due diligence on all potential ATOs before onboarding them. This diligence must be in line with the standard customer due diligence (CDD) process typically followed for individuals when opening a bank account.
Right, standard CDD.
Yes. Now, if an individual is already onboarded by the bank as, say, a business correspondent, BC, or a subagent, and proper due diligence was already conducted in that capacity, then that existing due diligence may be adopted for their ATO role. Importantly, periodic KYC updates of ATOs are now mandatory to ensure their continued legitimacy and minimize risk over time.
And what if an ATO becomes inactive? Say they don't perform transactions for a while. Does the system have a way to flag that and require re-verification?
Yes, it does. Under the inactivity protocol laid out in these directions, if an ATO has remained inactive, meaning they have not conducted any financial or non-financial transaction for any customer for 3 continuous months, the acquiring bank must carry out a fresh KYC of that ATO before enabling them to transact further. This is a critical security measure designed to prevent dormant ATO accounts from being potentially exploited or misused by unauthorized individuals.
How about ongoing risk management for ATOs once they are active? What kind of monitoring is expected from the acquiring banks?
The acquiring bank is required to continuously monitor the activities of its ATOs through their existing transaction monitoring systems. They must also set operational parameters based on the business risk profile of each ATO. This risk profile should consider factors like the location of the ATO is at high risk, the type of ATO, individual, shop, and the volume and velocity of transactions they typically handle.
Okay, risk-based approach.
Exactly. These elements must be formally included in the bank's overall fraud risk management framework and must be reviewed periodically to reflect emerging fraud trends. Finally, the acquiring bank must establish adequate system-level controls to ensure that any technological integration, like APIs used to connect systems, is strictly used for enabling AePS operations only and not for other purposes. This enhances the security and integrity of these vital digital payment touchpoints at the last mile.
Let's look now at 2 key indices that measure India's progress in financial access and digital adoption. These give us a good sense of how things are moving. First, the Financial Inclusion Index, FI Index, for March 2025. What exactly does this index represent? What does it track?
Right, the FI Index. The RBI constructed this composite index to capture the extent of financial inclusion across the entire country. It first published back in August 2021, covering the financial year ending March 2021, and it was conceptualized in consultation with various stakeholders, including the government. The whole idea was to create a comprehensive index incorporating details from banking, investments, insurance, the postal network, and the pension sector, giving a truly holistic view of financial inclusion.
What exactly does it measure and how is it scored? Does it give a simple, easy-to-understand number that shows progress?
It does. It captures information on various aspects of financial inclusion and boils it down to a single value. This value ranges between 0, representing complete financial exclusion, and 100, indicating full financial inclusion. It comprises 3 broad parameters, which together combine a total of 97 different indicators. Access, which has a 35% weight in the index, usage, with a 45% weight, and quality, with a 20% weight.
Usage having the highest weight. Interesting.
Yes, reflecting the importance of not just having access, but actually using financial services. And importantly, the index was constructed without any specific base year. This means it reflects the cumulative efforts of all stakeholders towards financial inclusion over the years, rather than just progress from a single starting point.
And the latest value for this index for March 2025. Is India making progress on financial inclusion based on this measure?
Yes, the value for March 2025 stands at 67.0. This is a noticeable improvement compared to 64.2 recorded in March 2024. The RBI notes that growth was witnessed across all 3 sub-indices: access, usage, and quality. However, the overall improvement in the FI index for FY 2025 was primarily contributed by gains in the usage and quality dimensions. This suggests not just more people having bank accounts, access, but more people actively using financial services and potentially receiving better quality service, reflecting a deepening of financial inclusion across the country.
Next, the RBI Digital Payments Index, DPI, for March 2025. This sounds like it specifically measures how much India is embracing digital transactions, right?
Exactly. The RBI DPI is a composite digital payments index constructed by the Reserve Bank to capture the extent of digitization of payments across the country. It specifically enables the measurement of the deepening and penetration of digital payments over different time periods. It comprises 5 broad parameters: payment enablers like internet access, accounts, smartphones, this has a 25% weight; payment infrastructure demand-side factors like merchant acceptance, 10% weight; payment infrastructure supply-side factors like ATMs, POS terminals, 15% weight; payment performance, measuring actual digital transaction volume and value, 45% weight; and consumer centricity, things like awareness, complaints, 5% weight.
What's its base period and how frequently is it published?
It uses March 2018 as the base period, meaning the DPI score for March 2018 is set at 100. It has been published by the RBI since January 1st, 2021, on its website on a semi-annual basis, twice a year, with a 4-month lag.
And the latest score for March 2025, is India truly becoming a digital payments powerhouse based on this index?
The numbers are pretty impressive. The DPI for March 2025 stands at 483.22. This is up significantly from 465.33 for September 2024 and 445.50 back in March 2024. So digital payments across the country registered a substantial 10.7% year-on-year rise as of March 2025.
Wow, nearly 5 times the base level.
Exactly. The RBI notes that the increase in the RBI DPI index was primarily driven by significant growth in 2 specific parameters: payment infrastructure, supply-side factors, meaning more ways to pay digitally are available, and payment performance, meaning people are actually using these ways more.
And just to put some context on the sheer scale of this transformation, any figures on total digital transactions?
Yes, the RBI release mentions this. India's digital payment landscape has witnessed over 65,000 crore, that's 650 billion digital transactions, amounting to more than 12,000 lakh crore in value just in the last 6 financial years, from FY 2019-20 to FY 2024-25. It really shows the massive scale and rapid adoption of digital payments in the country, truly positioning India as a global leader in this space.
Let's shift our focus now to India's position in the global economy, specifically looking at its international investment position, IIP, for March 2025. What exactly is the IIP, and why is it an important indicator for a country like India?
Right, the IIP, it's essentially a balance sheet, but for a country's external financial assets and liabilities. It gives us a snapshot at a specific point in time of what residents of India own abroad, their assets, and what non-residents own in India, the country's liabilities. It's a crucial indicator of a country's overall financial standing relative to the rest of the world. It signals its long-term financial health and, importantly, its resilience against external shocks.
What does the data for the latest quarter, January-March 2025, which is Q4 of FY 2024-25, reveal about India's IIP? Is our net external position improving or deteriorating?
The data shows an improvement. The net claims of non-residents on India, which is liabilities minus assets, basically our net debtor position actually declined by US $34.2 billion during Q4.2024-25. This brought the net liability position down to US $330 billion as of end March 2025.
Okay, so a decline in net liabilities is good. Why did that happen?
This decline was due to a higher rise in Indian residents' overseas financial assets, which increased by a strong US $60 billion compared to the rise in foreign-owned assets in India, our liabilities, which increased by a smaller US $25.8 billion during that quarter. So our assets abroad grew faster than foreign assets here.
What specifically contributed to that big rise in Indian residents' overseas assets during this quarter? Where are Indian entities investing or holding assets abroad?
An increase in reserve assets, things like foreign currency, held by the RBI, accounted for over 54% of this rise in Indian residents' overseas financial assets. This was followed by increases in currency and deposits held abroad by residents and also direct investments made overseas by Indian companies and individuals. It shows both a healthy accumulation of official foreign reserves and a growing global footprint of Indian businesses.
And looking at the other side of the ledger, the rise in foreign liabilities, what were the main drivers there for India? What kind of foreign capital came in?
The rise in foreign liabilities of Indian residents during that January-March 2025 quarter was primarily driven by an increase in loans taken from abroad, which contributed US $10.0 billion, and also inward direct investment, FDI, which added US $9.7 billion. Together, these two categories, loans and FDI, accounted for over 3/4 of the total rise in our foreign liabilities during the quarter. This indicates continued foreign interest in investing in and lending to India.
How significant are reserve assets in India's total international financial assets? Do they form the bulk of what India holds abroad?
Yes, they are very significant. Reserve assets, which include foreign currency reserves, gold held by the RBI, and special drawing rights, SDRs, from the IMF, accounted for a substantial 58.7% of India's total international financial assets as of end March 2025. This large proportion provides a strong buffer against external economic shocks and currency volatility.
And the ratio of India's international assets to international liabilities, is that trend indicating a stronger external position over time? How did it change in the quarter?
Yes, the trend is positive. The ratio of India's international assets to international liabilities increased to 77.5% in March 2025, up from 74.8% just a quarter ago at end December 2024. This clearly indicates a continued improvement in India's external financial position. Interestingly, the share of debt liabilities within total external liabilities increased slightly during the quarter and stood at 54.8%, reflecting the changing composition of foreign funding inflows.
What about the full fiscal year perspective, looking at April 2024 to March 2025? How did the IIP perform over the entire year? Was the trend consistent?
Yes, the trend was consistent over the full fiscal year 2024-25. The net claims of non-residents on India declined by US $31.2 billion over the year. This positive outcome was again on the back of a higher rise in India's external financial assets, which grew by US $105.4 billion compared to the rise in our external financial liabilities, which grew by US $74.2 billion.
What drove the asset increase over the full year? Was it still reserves and direct investment?
Pretty much. Over 72% of the rise in India's overseas financial assets during the fiscal year was due to increases in overseas direct investment by Indian firms, currency and deposits held abroad, and, again, reserve assets held by the RBI. This shows consistent drivers throughout the year.
And what about the liability side for the full year? Similar story with FDI and loans?
Yes, largely. Inward direct investments, FDI, loans taken from abroad, and currency and deposits held by non-residents in India together accounted for over 3/4 of the total rise in our foreign liabilities during the year 2024-25.
The asset to liability ratio for the full year then, how does that stack up compared to the previous year?
The ratio of India's international financial assets to international financial liabilities increased to 77.5% in March 2025, up from 74.1% a year ago in March 2024. This reaffirms the strengthening of India's external financial position over the past fiscal year.
Finally, how does this all compare as a ratio to India's gross domestic product, or GDP? This seems like the ultimate measure of our external financial strength relative to the economy's size.
Right, looking at it relative to GDP at current market prices provides crucial context. Residents' overseas financial assets as a ratio to GDP increased during 2024-25, while external financial liabilities as a ratio to GDP actually declined. This led to the ratio of net claims of non-residents on India, our net liability position, relative to GDP showing a significant improvement. It moved from negative 10.1% a year ago and negative 14.1% 5 years ago to negative 8.7% in March 2025.
So our net external debt position relative to GDP is shrinking.
Exactly. This indicates a continuous improvement in India's external financial position relative to the size of its economy, suggesting greater resilience and stability against potential global headwinds.
Okay, to wrap up our deep dive into the RBI news for July 2025, let's cover a couple more administrative and policy updates that demonstrate the RBI's ongoing role in economic development and smooth functioning. First, there's news about the formation of new districts in Arunachal Pradesh and assignment of lead bank responsibility. What's this about?
Right. A lead bank, just as a quick refresher, is a designated commercial bank given the primary responsibility to coordinate and essentially spearhead banking and financial development activities within a specific district. This is all part of the Lead Bank Scheme, LBS, which the RBI launched way back in 1969, following the recommendations of the Gadgil Committee. The aim is to ensure adequate banking and credit facilities are available in all districts across India.
Why is assigning a lead bank so important when a new district is created? What's the practical impact of this designation on the ground?
It's vital because it ensures continuity in banking operations. It helps with the efficient delivery of financial services, structured credit planning for the new district, and alignment with the district's overall developmental goals. Without a designated lead bank, financial inclusion efforts and development activities in a newly formed district could become quite disorganized, potentially leaving citizens underserved. It basically ensures a single point of contact and coordination for all banking-related matters in that new region.
Which new districts were formed in Arunachal Pradesh, and who's been given the lead bank responsibility for them?
The government of Arunachal Pradesh has officially notified the formation of 2 new districts, Gipanyer and Bisham. Accordingly, the lead bank responsibility for both of these new districts has been designated to the State Bank of India, SBI, which is, of course, a major public sector bank with extensive reach, well suited for this role.
Finally, there's a clarification on lending against gold and silver collateral, specifically for agriculture and MSME loans. This sounds like it resolves a potential ambiguity for both borrowers and lenders in these crucial sectors.
It does seem to clarify things. The RBI had, on one hand, earlier issued guidelines specifically to encourage collateral-free loans in the agriculture and MSME sectors, recognizing their importance and the challenges they often face in providing traditional collateral like land or property. On the other hand, the RBI also issued a separate, detailed set of directions specifically on RBI, lending against gold and silver collateral directions 2025.
Right, so potentially conflicting signals. What's the clarification here that ties these two aspects together, especially for small businesses and farmers who might have gold?
The RBI has now clarified an important point regarding this potential conflict. It states that if a borrower voluntarily pledges gold or silver as collateral, and the loan amount sanctioned by the bank is within the applicable collateral-free limit for that specific sector, like agriculture or MSME, then this arrangement will not be considered a violation of the guidelines that promote collateral-free lending.
Okay. So voluntary pledging is allowed even below the collateral-free limit.
Exactly. This clarification ensures that borrowers in the agriculture and MSME sectors are not restricted from voluntarily offering gold or silver as collateral, which might be their preferred or perhaps only available form of security, even if their loan amount would otherwise technically qualify for a collateral-free loan under the other guidelines. It provides much-needed practical flexibility.
So, in essence, banks may now accept household gold and silver as collateral for loans, even those under limits like 2 lakh, provided the pledge is genuinely voluntary from the borrower's side. This clarifies a potentially ambiguous area for both banks and borrowers, ensuring beneficial policies don't inadvertently create hurdles.
Precisely. It provides crucial flexibility and a practical solution on the ground, ensuring that policies aimed at helping don't inadvertently restrict access to credit for those who might rely on gold or silver as their primary form of collateral.
Wow, that was truly a deep dive into the Reserve Bank of India's news from July 2025. We've covered a lot new appointments, significant regulatory overhauls in KYC, project finance, priority sector lending, prepayment charges, and electronic trading platforms.
Along with key economic indicators from various surveys and indices like consumer confidence, inflation expectations, house prices, and capacity utilization.
Yeah. From the granular details, like risk weights for Basel III using a new rating agency, to the broad strokes of India's improving international investment position, we've really tried to break down complex information into digestible insights, hopefully helping you grasp not just what changed, but why it matters and its broader implications.
Absolutely. We looked at the Indian financial system and the economy from multiple angles, based entirely on these RBI communications.
My key takeaway from all this is how the RBI is consistently trying to perform that delicate balancing act, balancing financial stability with promoting ease of doing business and furthering financial inclusion. It's fascinating how they adapt to new technologies, like with ETPs and AePS, evolving economic realities seen in project finance rules, and emerging risks addressed in AIF guidelines. The sheer volume of detailed regulatory changes in just 1 month truly reflects a dynamic and responsive central bank.
It really does. And for you, our learner, maybe listening for exam prep or just to stay informed, what stands out from this deep dive? Perhaps it's those specific effective dates, January 1st, 2026, popping up for KYC amendments and prepayment charges, or October 4th, 2025, for the new project finance rules. Or maybe it's the precise percentages PSL for SFBs dropping to 60%, or those detailed provisioning requirements for project finance based on phase and sector. These details, they are the bedrock of understanding the financial system. Mastering them is key for truly being in the know.
So what does this all mean for you practically? Beyond just knowing the facts, consider how these changes might impact the financial products you use your bank account KYC loan prepayments. Or maybe the services you access, like AePS. Or even how you interpret broader economic trends in India, knowing about the IIP or HPI data. This information isn't just for exams, it's for navigating the financial world with more confidence, making informed decisions, and frankly, seeing the bigger picture behind the headlines.
And as the RBI continues to refine its frameworks, it makes you wonder, doesn't it? What do you think will be the next frontier of financial regulation in India? Perhaps in areas we haven't touched much on today, like central bank digital currencies, or grappling with the rise of decentralized finance and its potential impact on traditional banking. How might future policy changes continue to balance that need for innovation with robust risk management, especially as new technologies emerge and constantly redefine what finance even means? Something to ponder.
Thank you for joining us on the deep dive. We hope this detailed exploration has given you a richer, more nuanced understanding of the forces shaping India's financial landscape straight from the source. Until next time, keep digging for knowledge.